Relative equal highs and lows are powerful liquidity pools, but only if you know what to look for. Most traders mark them wrong or too early. In this video, I'll show you how to identify and use relative equal highs and lows correctly.
First, let me explain what I mean when I say equal highs and equal lows are strong liquidity pools. Equal highs and equal lows can work in your favor, and they can also work against you, depending on how you use them and where they form. So, before talking about how to use them, it's important to understand why equal highs and lows are considered strong liquidity pools. Equal highs and equal lows represent stacked liquidity in the market. This stacked liquidity naturally attracts price. The market is always looking for liquidity, and areas where multiple highs or lows form close to each other become obvious targets. Now, how do equal highs and lows form? They usually form during a trend. It does not matter whether the market is bullish or bearish. They can also form near swing highs and swing lows. Let me explain this in a simple way. Suppose the market is in a bearish continuation. Price makes a normal swing high. On its own, that swing high does not matter much. Normally, we would target opposing highs, opposing lows, or unfilled PD arrays, not random swing highs inside a range. But now notice what happens next. Price retraces, and within the next few candles, comes back to that same high. It tries to take the high but fails by a small margin. That is how equal highs are formed. The same logic applies to equal lows in a bullish market. Usually price will retrace once, fail to take the high or low, form two swing points close to each other, and then continue in the trend. That creates basic equal highs or equal lows. However, sometimes price will try more than twice and still fail to take the first high or low. When you start seeing multiple highs or multiple lows forming very close to each other, all failing to take the original high or low, that becomes what we call relative equal highs or relative equal lows. In simple words, if there are only two swing highs or two swing lows close to each other, those are equal highs or equal lows. If there are multiple swing highs or multiple swing lows clustered together, and price keeps failing to take the first one, those become relative equal highs or relative equal lows. Now here is the most important part. It does not matter whether the equal highs or lows are basic or relative. We use them the same way in trading. The difference is in their strength. The more highs or lows that are clustered together, the stronger the liquidity pool becomes. More highs or lows close to each other means more resting orders. More resting orders means more attraction for price. That is why areas with multiple equal highs or equal lows tend to get targeted more aggressively by the market. Now let me show you how you are going to use equal highs and equal lows properly in your trading. Now let me show you the ways you can use these equal highs and equal lows in your trading. There are actually two simple and practical ways to use them. The first way is by using them as targets. I am not saying that you should only target equal highs and equal lows in every trade. That is not the point. What I want you to do is align them with your targets. If you already have a trade planned, and you notice equal highs or equal lows sitting close to your target area, especially near a swing point, you can comfortably target those levels. Because equal highs and equal lows are strong liquidity pools, price is very likely to move into them before reacting or reversing. So instead of blindly targeting a swing high or swing low, you can fine-tune your target by aligning it with nearby equal highs or equal lows. This helps you exit your trade at a level where price is naturally attracted. The second way of using equal highs and equal lows is to avoid getting stopped out. This is very important, especially for beginners. Suppose you have a sell-side liquidity sweep. You have your bias clear. You have your entry planned. Everything is aligned. You are ready to enter the trade. But then you notice something important. You see equal lows sitting just below the liquidity sweep. In this situation, instead of entering immediately, I want you to wait. Most of the time, price will first move down, sweep those equal lows, and only then continue in the direction you are expecting. If you enter too early, there is a high chance you will get stopped out before the real move happens. By simply waiting for those equal highs or equal lows to get swept, you can avoid unnecessary stop-outs and improve your entries. The same logic applies on the other side as well. If you are looking for shorts and you see equal highs above your setup, price will often take those highs first before moving lower. This small observation alone can save you from many bad entries. Now let me show you how all of this looks on the charts so you can clearly see how to apply it in real market conditions. Let me show you an example that explains both uses of equal highs and equal lows. Here you can see that we first have a buy-side liquidity sweep. After this, what most traders usually do is wait for any kind of entry confirmation. In this case, we actually have a strong confirmation. You can see a market structure shift to the bearish side. Because of this, most traders would enter at this fair value gap formed after the structure shift and target the sell-side liquidity. And technically that approach is not wrong. But now let's see what happens next. Price moves against the position and we get stopped out. If you look at this trade without context, you might not understand why you got stopped out. But if you look carefully at the left side of the chart, you can see something important. You can see equal highs sitting above price. These equal highs acted as a liquidity magnet. Price was attracted to them, so before continuing lower, price first moved up to take those equal highs. That is the reason the trade failed. Now let's see what happens next. After sweeping the equal highs, we again wait for confirmation. Here you can see that price gives us another market structure shift. Now we can plan a new trade. This time, we enter using this order block as our entry. Now let's talk about targets. If we look lower on the chart, instead of blindly targeting the swing low or opposing side liquidity, we can see that there are equal lows sitting just above that area. Since those equal lows are aligned with the opposing side liquidity, we can comfortably target that level. Now let's see how this trade plays out. You can see how cleanly price respects the order block and moves straight into our target without any hesitation. This example clearly shows why I always recommend observing equal highs and equal lows in both directions. You should look for them in the stop-loss direction to avoid getting stopped out, and you should look for them in the target direction to add extra confluence to your targets. This small adjustment alone can make a big difference in your trading. Now let me show you one more example so this becomes even clearer. Here we have one more example to make this concept even clearer. Once again, you can see that we start with a buy-side liquidity sweep. Just like before, after liquidity is taken, we wait patiently for any type of confirmation to plan a trade. In this case, you can see that price forms an inverse fair value gap. So most traders would naturally enter at this inverse fair value gap and target the opposing side liquidity. Let's see what happens next. Instead of reaching our target, price moves against the position and we get stopped out again. Now the important question is, why did this happen again? If we had been a little more observant at the time of entry, we could have avoided this stop out. The reason is very simple. There were equal highs sitting above price that had not yet been taken. Price was attracted to those equal highs, so instead of moving directly lower, it first moved up to sweep that liquidity. This is exactly what caused the trade to fail. Now let's see what happens after those equal highs are taken. Once price sweeps the equal highs, we again wait for confirmation. This time you can see that price gives us another inverse fair value gap, along with a clear change in the state of delivery. Now we have a much better setup. We enter at this confirmation, place our stop loss above the highs, and then plan our targets. If we look lower on the chart, you can see that we have equal lows sitting just above the opposing side liquidity. Because those equal lows are aligned with the swing low, we can comfortably target that area. Now watch how price reacts. You can see how cleanly price moves into our target, respecting almost every premium level along the way. This example clearly shows how important it is to pay attention to equal highs and equal lows. By simply waiting for them to be taken first, you can avoid unnecessary stop-outs and enter trades with much better timing and probability. So this is how you should look at equal highs and equal lows in real market conditions. They are not random levels. They are liquidity pools that the market is actively targeting. If you ignore them, they will work against you. If you understand them, they will work in your favor. Before you enter a trade, always check where the equal highs and equal lows are sitting. Look at them in your target direction and also in your stop-loss direction. This small adjustment alone can save you from a lot of unnecessary losses and improve your trade management. Keep your bias clear. Be patient. Let price take liquidity first. If you found this video helpful, make sure to like it, share it with someone who needs it, and subscribe for more content. If you want to connect with me, you can join my Discord and Telegram. All the links are in the description. If you want to learn privately from me, the mentorship link is also in the description. I've also left Prop Firm coupon codes down there if you're looking for those. That's it for this one. I'll see you in the next video.